Since 1965, the legend Warren Buffett has brought in more than $660 billion in value to his shareholders, which equates to an impressive 20% each year. So it's no wonder why investors want to see what he's buying. With inflation at a 40-year high, quantitative tightening by the Fed, and yield to date the S&P 500's worst return since the Great Depression, it's no wonder why Buffett has been on a massive shopping spree. While he is known as a great value investor, he also cares about his dividends. Over the next 12 months, Berkshire Hathaway is on pace to collect more than $6 billion in dividends alone. On Monday, June 28th, Buffett announced a purchase of almost 800,000 shares of ticker symbol OXY, Oxy, or Occidental Petroleum Corporation, giving Berkshire Hathaway a 16.4% stake in the Texas-based oil company. Berkshire is the largest individual shareholder in Oxy, with a total of $9 billion invested in the company. The company also owns options to buy another 83.9 million shares, which would bring the total exposure to 25%. Buffett's two highest dividend stocks happen to be both oil stocks, with Oxy at a 0.9% dividend yield and Chevron CVX at a 3.4% dividend yield. Oxy is an international energy company with assets primarily in the US, Middle East, and North Africa. With over a 100-year track record, they are one of the largest oil companies in the US. With a huge increase in gas prices, Oxy looks well positioned to capitalize on crude oil prices hitting multi-decade highs. Between Russia invading Ukraine and oil companies paring back capex over the past 2 years, getting supply back into the market will be very slow. This means oil prices will persist, unfortunately, for a long time. In late 2021, Oxy launched its new Zero In brand with an important goal of making a low-carbon future and eventually lead in carbon management. Oxy is focusing on an aggressive platform of sustainability and social responsibility for the future. While Oxy gained record free cash flow of $8.8 billion in 2021, they also are working to reduce debt, and in 2021 they actually paid $6.7 billion in debt. They also recently completed a large-scale divestiture program to get rid of unwanted assets. The company grew last year as well, with record earnings, and reserves increased by 600 million barrels of oil per day. As oil is a wildly cyclical industry, Oxy's track record of net income has been very volatile. After modest profits in 2017 and 18, earnings went negative with the acquisition of Anadarko Petroleum, and in 2020, the company lost $13.5 billion. In 2021, revenue bounced back, and analysts are forecasting a 25% increase in revenue for Oxy in 2022. The cyclical market is important to note, as the company does not have steady income and therefore may not be able to pay dividends to shareholders in the future. Oxy is currently $61.71 with a 0.9% dividend yield. While the dividend yield is low due to a huge dividend cut in 2020, before 2020, Oxy was a strong dividend stock with an increasing yield. If management is able to get rid of its debt and increase revenue, I believe the dividend yield will rise again, and this could be a great turnaround play. PE ratio is 9.23 with a market cap of $57.83 billion. It has a 52-week range of $21.62 to $74.04. While its share price has more than doubled yield to date, in a 5-year time period, the price is actually down 2%. While this may indicate this company has a great runway to grow, Buffett has only been buying Oxy around $50, with his average share price at $52. This recent rocket may indicate the company is a bit overvalued in Buffett's eyes currently. Since 1991, Oxy delivered 16 consecutive years of rising dividends at a 12% annual increase. In 2020, Oxy cut its dividend and is now back to paying a small dividend that increased in 2021 by 3%. I believe management will begin to increase dividends as it lowers debt. Oxy also recently announced a $3 billion share buyback program, which equates to about 5% of shares outstanding. This shows management cares about its shareholders. With a great turnaround story, huge economic tailwinds, and dividends being reinstated, it makes sense why Warren Buffett would purchase this oil behemoth. For retail investors, I believe a fair value is $48 per share, and I would be cautious with this stock. I would wait for a pullback to a better value, or I would simply invest in a company that wasn't as cyclical. As a dividend investor, I personally like great companies with steady and consistent revenue and dividends. Instead of Oxy, I would choose Sunoco, ticker symbol SUN, which is one of the largest auto fuel distributors in the US that generates stable cash flows with stable long-term contracts, and it has a steady 8.6% dividend yield. While oil prices seem to remain high for the foreseeable future, investing in oil and gas companies may be advantageous for retail investors. Oxy shows signs of being a good turnaround play, but at the current price, it seems overvalued. I also need more of a track record after its plummet in 2020 before I start investing in this company. Let me know your thoughts below. Thank you for watching. This is Supergirl Investor here to save the world and make you wealthy, happy, safe, and healthy investing, and have a great week. See you in the next one.